Howdy, Jacob here. Today we're looking at WW Grainger, and it is in the trading companies and distributors industry on 48.5 billion market cap, just over a 50 billion enterprise value. Founded in 1927. Revenue pretty substantial, 9.9 billion in 2014 to 16.5 billion in 2023. Return on invested capital 21% 10 years ago, and now 30%. And in the most recent year, balance sheet looks pretty good. 660 million cash on hand with about 2.3 billion total long-term and short-term debt. In relation to their 5-year average free cash flow, that is maybe a little over 2 years. So really no concern on the balance sheet. And on the cash flow statement, pretty much gushing cash flow. We see that cash from operations is double, and capital expenditures are maybe 30 to 40% higher. The use of cash has very consistently been repurchasing shares and paying a dividend. Okay, their repurchase of shares have been very substantial for the last 10 years. Their dividend payment is roughly, what are we looking at? Maybe 30% of their 5-year average free cash flow. So majority is going towards stock repurchases. So let's do some assumptions and see what we're looking at here. So revenue growth, pretty slow growth actually at the end of the 20-teens, but pretty substantial now. Maybe 5% growth over the next per year, 5% annual growth for the next 7 years. Maybe a 16 PE at the end of those years, since you have premiums for PE based on reinvesting at high rates of return. They do have a high return on invested capital, but their reinvestment rate is very low, which you can see from their capital expenditures increasing very small, and the majority of their payout of free cash flow going towards buying back shares and paying a dividend, which there's nothing wrong with that, but you don't necessarily get the premium that would come with most 30% companies, 30% ROIC companies that do reinvest back in themselves. And then for margins, what did I see? Margins are actually going down on the gross margin side, but up on the operating margin side. So let's see what the average looks like. 8%, 7%. I'll probably just do that. Let's say they buy back 2% of shares. The dividend, they can afford that. Let's raise that relatively in line with their revenue. And yeah, right now it just looks a little bit expensive for me. So this would be one that I would just wait to do more research on until the price looks a bit more attractive, but definitely looks like a great company from the numbers side. But from a valuation side, I will just be waiting it out. Thank you, and have a great rest of your day.